Like, what's the real job of the CFO? The real job is to have insights that lead to recommendations that ultimately either drive EBITDA or valuation.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's episode, we have Brennan de Raad. Brennan is the founder and CEO of Vessel Advisors. He is CFO, controller, and accounting services company with over 40 professionals dedicated to empowering business owners with financial clarity and control. With over 10 years of experience as a fractional CFO, Brennan has personally served over 50 businesses representing close to $1 billion in combined annual revenue. And today we're going to dive into what services Vessel Advisors offers, what is a fractional CFO, and how a fractional CFO could potentially help you if you own your own business, you're looking to buy a business, or you're looking to maximize the value as you exit a business. Brennan, welcome to the show.
Great to be here. Thanks for having me, Chris.
Absolutely. Yeah. So, in Next Level Income, we're always talking about, investments, but really, I just got off the phone with, or call with another investor. And I just said, hey, what are you doing kind of to optimize your taxes and your financial planning? And I know this isn't the sexiest thing in the world versus talking about investment opportunities that are out there. But I think what a lot of people don't realize, Brennan, is, when you can save $1 on taxes or save $1 in your business, that dollar falls right to your bottom line. So I'm really excited for you to share a little bit more about what you and Vessel Advisors does. But before we do, I know we just shared a little bit about you in the intro here, but share a little bit more about your background, your history, and how you started Vessel.
Yeah. Well, again, thanks for having me on. This is awesome.
Yeah.
A little bit of background. Vessel Advisors is a fractional CFO, controller, and accounting services firm. So we act as that scalable back office. When you're trying to make a decision on, am I going to hire kind of a lower level, entry level person, ask them to do some high level things that doesn't always work well, or on the flip side, hire more experienced individual and then asking them to do some more level things. I got into this and started this company about 8 years ago, and it was coming out of a couple things. But one was working at a startup where oftentimes I felt like I needed to cut myself into a couple different pieces: CFO, controller, staff accountant, forecaster, FP&A as we call it, maybe some data science, maybe some visualization. And we only had so much budget, right? You're a fast growing startup. The money's going to R&D and just some other things. And I thought, man, if I could have a portion of each of these, it would probably go a lot better for everyone involved. And then the other is just, I think, the shift, like right now in the last 4 or 5 years of a lot of accountants, industry is a little impacted. And so the idea was, well, what if we could, create a great solution for people that maybe want to work from home or that are high performers, but are okay working remote, and matching that up with really great companies that need the help, but not nearly, 10 hours a month, 50 hours a month, 20 hours a month. I got my background doing, I was an econ major and did a lot of accounting work coming out of school. So really exciting. But I had the fortunate blessing of working for a guy who was extremely entrepreneurial, also a CPA, which doesn't always go together. That's, you kind of think of CPA and maybe all the stereotypes, and you don't think of that. So that's kind of how we got started, or how I got started very early on in accounting, got exposed to that, I'd say, kind of entrepreneurial finance and mindset of being able to really leverage accounting and financial planning in the business, specifically building pro formas, building scenarios, and then actually reviewing those and comparing those and getting better, more and more aligned as the months and quarters go on.
Yeah, no, fantastic. And I might be a little unusual, but econ was my favorite class in my MBA program. So I loved it. I had an Austrian professor. Yeah, I had an Austrian professor. It was fantastic, accent and everything. I found it was my highest grade, because I just found it interesting to read the book and go through all that.
I'm gonna have to recruit you. Be careful.
I don't think I'd make a good accountant, but I more of a hobby. But I know a lot of listeners, they're like, I know what an accountant is. I know what a CPA does. I know what I do, and a lot of people hear about what a CFO does. But let's start with that. How's an accountant, or how's a CFO different from an accountant, Brennan?
Yeah, question. So we talk about CFOs, their job is to be the ones looking up and looking out. So that's the best visual I can give. Or maybe an accountant or even a controller who's more of that manager level that sits on top of different accountants. They're looking down, right? They're focused on the month flows, precision, day-to-day activities, bill pay, technology processes, things that are going to make that machine work better. The CFO's job is to look up and look out. And generally they're coordinating with a CEO or a business owner who already has a vision, and they're translating that into accounting speak, or they're building the financial plan for that. It's like, I want to grow 3x in 5 years. Okay, well, how does that actually work? Someone needs to be looking up, looking out, and then advising on that. So that's how we usually describe it. And then we think about staff accountants as really head down, precision focused, right? Accuracy focused. They're each transaction, they're looking at documents, or they're reviewing a lot of automation now in AI.
Yeah.
The CFO is generally receiving those reports towards the end of them, and then actively working with the business owner throughout the month, understand what's changing in the business. Their time is best spent meeting with, in a large organization, different department heads, ideally weekly, but at least a couple times a month, and trying to bring all that together to identify some things maybe that need to be optimized, changed, or best case, if you find something that's working really well, you're looking up and looking out that aligns, right? Oftentimes we're the first one to identify it, put the flag up, and let the team know that it might work for their investigation.
Yeah, I really like how you describe that, looking up versus looking down, because or looking forward even, right? Like kind of looking forward and how to do that. And the world has changed a lot. We have small businesses, we have medium, large businesses, but we also have a lot of these entrepreneurs, like myself, who are now working, out of a home office or a small office with a remote staff, which has become more and more popular. Because you can live in a great place like Asheville. Southern California is not too bad either, as we were discussing with the weather out there. But who do you find that typically benefits the most from this? Or at what stage does a small business kind of enter the realm where they say, hey, I could really benefit? Because I know me, I'm like, I'm not going to hire a full-time CFO, but fractional CFO that could come in a few hours a week or, several hours a month and really help out with this. What levels of business do you find really benefit from a fractional CFO service?
Yeah, as always, it depends. I would say always have at least the conversation, because even like in your business, you might say a couple hours a week. You probably don't even need that. You probably want someone to come in for a short period of time, get to know the business, and then it's maybe 3 to 5 hours a month, right? It's is as our good Craig Ballantyne says, an outside eye on what's going on in your business from that angle.
How? Right next to your right side of your head there. Who, not how. That's a great example of that.
How's there? Yep. I got Craig's 9 out of 10 over here too, or 11 out of 10.
11 out of 10. Whoa, don't let him hear you say that. Yeah.
Get the number up.
That's right. I got his, here you go. Sorry. Quick shout out for Craig. He was just on, Craig and Dale. Do you want to do this? Okay. Yeah, let's do this, man. Let's do this. So if you missed the episode, he's out. Oh, that's terrific. That's a whole stack. This is my pre-order with a book. And Ted has been fantastic.
Read it in a weekend, and then bought a stack of them to give away. So
yeah.
But good example. We work with clients that are pre-revenue startups, all the way up to $100 million a year in revenue. So when you say what's the ideal, it's more about having that optionality to drive that person in maybe for a short period of time. In a pre-revenue startup or an early stage business, or if you're looking at maybe a transaction, it's only a couple hours for just somebody to look at your model or to take a look at your thesis or your theory and advise, okay, here's directionally where I would take for a startup that fundraising strategy, or for a property, to poke some holes in things. We've private equity firms that'll come in and say, hey, we want you to do the financial due diligence. We'll take the and the people and the management team and all that. We want you to just be the eyes on this one piece. I would say generally, around that $3 to $5 million a year in an business is when you probably can't afford to not be doing this anymore. Can't fake it till you make it too much anymore. And then, man, you'd be amazed. We work with multiple $100 million businesses right now over the course of Vessel's history. It's not the most common, but you'd be amazed when you get into a business. They've just been executing at the level that they know how to. It's not that that's bad, right? That's more like the optimized. They're making millions and millions of dollars a year, tens of millions in some cases. Fantastic. Why don't you have somebody else come in and look for some of those basis points in each area? And oftentimes in the business of that size, we just worked on one. Very common to find a couple $1 million a year in savings just by
Yeah.
diligently working through people, process, technology, really understanding the business and saying, did you know you can do this? Did you know you can do that? Here's what it would take to execute on that. That's a 2-week project. That's a 2-year project. And then the business can sit in a position and go, okay, I am going to self-select into these 3 things, and my team can do the first one. And then, fractional CFO, I'd like you to do number 2 and 3. And then we'd like to begin in 6 months, right? And reevaluate kind of how things are going. So it really gives that, I think flexibility is probably the best way of describing it. And I would say don't shy away from sharing everything that's going on, because this person is fractional has the benefit not only of having maybe 15, 20, 30 years of experience as a CFO in a full-time role, but if they're working like in an organization like ours, they're probably working on 3 to 5, maybe even 3 to 6, 7 different clients at the same time. And so we're trading across about 35 different CFOs, best practices and learning.
Wow.
So being this massive, again, technology.
Like a brain trust. Yeah.
Yeah. That's a great way to put it. Like I need to write that down. Brain trust. Like you're getting so much more than the hour you're paying for or the monthly fee you're paying for, because that's coming in, and then you can also turn it off when it's done. And I think when you hire a C-level person at any organization, there's just a cultural side of, if we're going to let go of somebody that size or that person leaves, there's just a cultural impact. Whereas if you're hiring fractionally and you're hiring a consultant, it's a lot easier to kind of, again, scale it up and scale it back down.
Yeah, I never thought about it that way. So not only can you come in at an earlier stage company and scale with them, but you can actually provide some protection around that position, because that's a huge disruption. We had a disruption in one of our businesses last year where we had that our CFO was pregnant, and she decided, she's like, you know what, I'm out. I'm gonna stay home, and I can't do this anymore. And it left a big hole that we had to go back and took months and months to kind of go back and do that. So that's
CFO plays a really big role usually in strategy, and then they also know how a lot of things work. There, the CFO's job is to free up usually a business owner or leadership team to know what they do really well, which is not the financial side. They're out selling, building vision, new product, handling things that are out in front. And that's it's not an uncommon scenario that we walk into where the business owner knows, hey, in 3 months or in 6 months, I'm going to have a transition in this position. We want to use it as an opportunity to reevaluate, what are we doing well? What are we not doing well? How could we improve? Do we need that level or that title? Or is there a better mix of resources? And we do a lot of work like that on assessments that I personally love, because you get to get on site with a client for a few days. You get to meet not just your ship, but every accounting team member. You get a lot of feedback. You look at the technology and go, hey, did you know you could do these 12 things and probably have a better accounting operation? Same or less cost very frequently, or at least within 6 months, less cost. Reporting, or whatever the thing is that that CEO wants, that's been hard to get or difficult to get because it's not a priority. That thing can be done. Those are fun. Those are rewarding engagements.
Yeah. And, not only do you have the ability to come and kind of coach the financial team, if you will, but like you said, you also have, more of a breadth of knowledge. I used to go in to surgeries, and I'd work with a surgeon that might see that specific surgery once a year. I mean, it was a kind of a crazy trauma surgery, but I'm seeing them every week, or our team's seeing them, repeatedly. And, you're able to see these problems, and, I like that. You probably solved this problem in some other business and be able to bring that knowledge and expertise to do that.
Playbook with that from to the
yeah,
exactly.
I know you and I were talking, you even help businesses optimize, like you mentioned basis points. Like you said, hey, here's an opportunity where this business could earn a few more percentage points on their cash, for instance. Can you go into, some of these instances where you come into businesses and, maybe examples of low hanging fruit? Yeah. We were talking about a vehicle, like, utilizing business vehicles and those sorts of things. And you can use that, but just any specific examples that you have of low hanging fruit.
There's a bunch. There's a bunch. So, in the last, if we were talking 3 years ago before interest rates were rising, your treasury management as a CFO, that job was, for a small business, there wasn't a lot you could do with minimal risk. As rates started moving up, right, all of our CFOs at Vessel, part of the conversation was, okay, let's start paying any clients that are holding, it could be $100,000, it could be millions of dollars, whatever you're holding that you don't need in your operating account, but you're keeping, let's go ahead and set up brokerage accounts or a minimum of money market, which they usually would already have, right? A sweep, which if our listeners aren't familiar with that, it's just like a daily or it's an automated process. It's a little lower than maybe a treasury bill. Yeah. That's an example of we could come in, even if they're doing a good job using a sweep, we could come in and find another, probably 40 to 50 basis points in T-bill rates. And at one point, I think we were over 5. And so we would ladder bills, or we would, provide, hey, you're going to buy 30, 60, 90. We'll look at a cash flow. They, really very low likelihood you're going to need this. If you do, there's a slight discount, right, to point it back, or a slight risk to point it back. And that, when you have millions of dollars, or in some cases, I think we had a client with around $8 or $9 million of operating cash that was just sitting. It's, again, no one's thinking about it. They're just the CFO that's in the financial person that's in there is comfortable, right? They're like, sweet, right? I have plenty of cash now. I don't have to worry about bills. But a good CFO is going to sit down and go, okay, what do we really need? And then can we move it, monitor it daily, weekly, bi-weekly, and manage it? So that's a good example of adding a lot of value. Another one that we routinely do in professional service firms is the firm might not be measuring the utilization or the realization rate. So what that means is, if you've got an employee and you need them to bill 50 hours a year, 1,800 hours a year, 2,000 hours a year, maybe at a law firm or a more aggressive firm, or much higher at a big law firm. There's not a management and monitoring system there. There is if you're at a huge firm, because that's how they run their business, but it hasn't been set up. So we'll do what we call the retroactive 12 and the forward-looking 12. So retroactive is everybody on the team and just a quick little heat map, which is a color for each person for each week. And it's basically green, yellow, red. And if it's red, right, that means that something was not working. And it's probably not the individual's fault in the team. It's probably a resourcing issue or a management issue. And so we'll get the team together to understand that. And then we'll look out 12 weeks and say, okay, the whole team is booked out for the next 2 weeks or 6 weeks or 8 weeks. There's some level there that drives hiring decisions, or says, hey, sales continues to grow the pipeline, or we're closing at a faster rate. We really need to accelerate hiring. You can use that tool and utilization to really optimize folks. And at a minimum, we usually move that needle. Say if the average was 65 or 70%, we're able to move that needle up, 4, 5, 6 percentage points on the utilization, usually within 90 days. And what's cool about that, and like bottom line, right? It's the same overhead. It's absolutely cost. It's just, again, outside eyes, somebody looking at it. And then I think a thing that a good CFO brings and a finance team brings is just consistency. Get your financials on the same day every month. Get your weekly reports on the same day and same time every month. Review them at the same cadence every. When you do that, you're looking and you'll get insights, because you'll see when things are different, because you'll just know intuitively after 6, 8, 10 weeks as a team, that doesn't look right? Is it a data integrity issue? Probably not after 6 or 8 weeks. It's probably an actual operational issue. So that's a good one for utilization. Yeah. And then on the technology side, you'd be amazed how many accounting departments aren't leveraging what they can. Maybe they're in QuickBooks, or they're in NetSuite if it's a little bit larger organization. In real estate, they're in Yardi or MRI, but they're not really leveraging the tools that they could be, or the optimum they could be. And so we'll come in, assess that, and say, hey, this thing that was taking you 10 minutes, 5 minutes, 7 minutes per invoice, per transaction, that should take 30 seconds. That should take 10 seconds. That should be a sample size at the end of the month, because everything can be automated through this app. And again, going back to our assessment kind of service and structure, that can be stack ranked against everything else. So you can do that, but it's a low value. It's not going to do that much in the short term. But if a CFO is looking at your business and you go, I want to grow 3x in 5 years, 2x in 2 years, 3x in 1 year, if you're an early stage startup, we want to invest in those technologies early, so that we're not trying to throw additional headcount or stress out the existing team for months and months while we wait to make a decision.
I love that. And, one of the things we've seen, AI is just amazing at how fast it's progressing. And we're able to have, like my executive assistant, she's been able to utilize AI to help supplement her and figure out things, or editing our podcast, pulling out clips and all these things. I use it to help with my editing for my weekly emails. So what are you seeing on the accounting, on the financial side, in terms of AI and how that can help with some of the scaling and cost reductions?
Yeah. So when people ask me this question, it's been there for a while in lighter forms, right? So a lot of the transaction matching and things that have been going on really for maybe even 10 years, going back to early versions of a lot of folks probably know Bill.com, which is now Bill, and different expense card automation tools. Their data, and they're saying, okay, well, if you went to this restaurant, or you went to this, you spent on this product, 97.2% of all businesses in our system, right here, or put it to this account. they're going to default it to that account. And then again, the accountant's job is to come in and make that change. And then usually once you do that once for that vendor, it's done forever unless you need to put it like to a job code or a OD testing system. And so that's been around for a long time. So I think what's crazy is most people have not purchased a lot of those tools, and that's what we'll start with. We'll say let's get places. I think what's exciting in the AI space, we spend a lot of time just trying to keep up with it in our teams constantly, and the apps that everyone's using. But from the accounting side, we're trying to match and understand the security piece of it, because there's so much principle. There's also this risk, right? There was a big article, I think, about a month ago in the Wall Street Journal about, financials being uploaded to one of these tools and then being turned over to another completely separate party and the results, right? So they're feeding it, and there are private versions, but to the extent that we know or don't know, that's the risk side of AI right now. But once that's released, once that's solved, and again, at the enterprise level, it probably is beyond our typical size. But once that's solved, I think the opportunity is massive, because the things that you're doing as a CFO really is you're doing trend analysis, and then you're trying to determine like what's the story, what's different, what's changing, and then what does that mean? And over time, if we can leverage these tools to say, write those reports, right? Hey, consume all these different financial statements and write the summary, or better yet, have the insight. I mean, we can teach a lot of these things, just like what's the AI tool? Like some of these folks we've worked with have created their own little bots. So like, you feed it your own.
We've done that. Yeah.
Or your own way of working. And so that's the angles that we've been trying to investigate and learn. And our sample size isn't quite big enough to make it too meaningful yet, but over time it will grow. And the idea is, okay, generally for all of our CFOs, like how would we handle this as vessel? And then how would we specifically handle it, with the individual team, and hopefully what that does over a long term democratizes, the information and that kind of brain trust into almost its own little agent going forward. But we'll see. That's in the future.
No, I love it. I mean, I've been uploading all my content into a Chris GPT, so you can go in there and search for that. And it's funny because I still have, I've got longtime listeners of the podcast, and they'll say, "Oh, you should do a podcast on this." And it's like, I did that 4 years ago, So now they can go in there, they can say, "Hey, do you have any podcasts on senior housing, for instance, or CFOs?" And it's right there on our website. It says, "Ask me a question" there on the bottom right. But it's pretty wild. Yeah, I think eventually they'll be able to do my podcast for me. You'll be sitting here talking to like Max Headroom back in the day. You might be a little young for that, but
you can. Well, so it's funny you mentioned that. We as a team, we've looked at marketing for our business. Interesting. It's a high trust business, but believe it or not, I don't love doing a whole bunch of like video or doing the content. I'm getting used to that. One of the things that the marketing company that we're working with showed me was, he's like, it's not quite there yet, but it's like we can definitely recreate your voice. And then the image, or the like your personal image is in process. And the ones that exist, like you can pick from hundreds or thousands of people that maybe look similar or don't. But it's just a little, but man, it is close. Like when I'm watching these, it's like, every 4th second you kind of notice something isn't quite human. But give it a year or two. So maybe our bots will be having this conversation. And
there you go. That's incredible. Yeah. Let's not get too carried away, but that's pretty wild. And one of the other things we talked about, Brennan, you guys, and you kind of touched on this a little bit earlier, but you also help companies prepare for exit, to optimize valuations in terms of exit. And you don't have to speak of specifics, but maybe you can share a little bit about how your team does that, or maybe an example of exit that you've helped facilitate.
Those are fun. So in our initial assessments, if the company says, "Hey, our intention is," or they get introduced to us because their intention is to sell within a short period of time, or relatively short period of time, let's say 6 months to 2 years, we're going to run a process from an accounting lens, from a finance lens, and that's going to be driven on a couple of things. We want to get through financial due diligence successfully. You got to kind of the business owner has to put themselves in the shoes of their buyer and really their analyst. There's going to be an analyst in there who's poking at everything. So we want to ensure that you have 24 months of extremely clean financial statements. We want to go back through really line by line at the general ledger level and identify all those. And then we also want to forecast out for you at 12 months. You'd be surprised how many companies that are getting ready to sell don't really have a strong even 2 or 3 year forecast. Maybe they have a 1 year. So we'll start with the 1 year and extrapolate that out a bit. Our job is to also sit between the investment banker and the client for a period of time. So we're preparing them for some of those conversations. We're not actually them to market. We're not, not a broker dealer or doing any of that work. But our job is to ensure that their operations are working. The other thing that's really, really key in a sale is what are called add backs. And so we want to identify in those prior 24 months, what was the business spending on maybe that weren't completely, business expenses, or like in a small, you might take as an owner of like a single owner or two owners, you might take a deduction for tax, or you might do something that's tax advantageous. That's actually not great is for your earnings, right? Your EBITDA or your net.
Absolutely.
Yeah, your business. Your business is generally going to be valued on that. In some areas, it's different industries, it's different. Let's just say 90% are going to be valued on a multiple of EBITDA. And so we want to drive historically a narrative, a conversation with that future buyer and saying, yes, it was this number, but really it was a higher number because of this, this, and this. And we could show you.
They're paying their brother-in-law or something.
Yeah. Family members, autos, other types of toys, marketing expenses, things that, are maybe superfluous that weren't necessary, or, you can show clearly, okay, this is really what's driving the revenue. So it's that mindset though, that CFO's mindset, and really a controller's mindset, who comes in and works through a checklist to say, okay, I think we can add back, sometimes it's 5, 10, 15% to your bottom line. And if you're
huge,
shopping at anywhere from usually like a 4x on the low end to maybe a 10 or 12x, 13x on the high end, that's real money, and it's going to, make a big difference in the transaction. And then on a go forward basis, I would say, we're preparing them to start thinking like, they're going to be in the transaction. So what that means is right now, maybe they set a budget and it's a hope. I think we'll get there. Once you move into a transaction, you need to hit your numbers, or you need to be within 90 to 110% of your number, top line, bottom line. So we want to predictability and kind of force that, that discipline into the entrepreneur or into the leadership team if it's a little bit bigger company, and say, hey, we made a month. Here's why. We should be uncomfortable. In the past, we weren't, but we should be uncomfortable because if this was during the transaction, this could have a material effect on the buyer made it out or wanting to retrade or change some terms or change some pricing or extend the team out, another year beyond what they had already agreed to. And so those are really dynamic. I would also say, run your business like you're going to sell your business. You don't have to. No one has to sell it, but run it like you're going to sell it, because then you're constantly using that discipline mentality and making objective decisions as though maybe in a year or two someone was going to sell.
Yeah. No, that's massive. And like you said, not only are you getting that money to the bottom line, but if you're selling in the near future, you're getting a multiple of that. So you save 10%, that could be worth another 50% on that, which is, that's fun. I see you smiling because that is fun.
That's where you really add value for a client in a CFO seat. We joke internally, like, what's the real job of the CFO?
Yeah.
Real job is to have insights that lead to recommendations that ultimately either drive EBITDA or valuation, right? They're enterprise value focused, long-term focused, then maybe everyone else is just head down trying to, sales is trying to hit their monthly or quarterly number. Marketing is trying to, these KPIs. The CFO's job is to say, okay, what's this business going to be worth in 3 years if the goal is to sell? And are we, maybe not all revenue is equal, right? Not all margin is equal. Like, how are we moving the levers of the business for that future buyer in 2, 3, 4, 5 years?
I love that. As we wrap up here, Brennan, I want to kind of have a little fun and kind of look at the current political landscape, the economic landscape. We may have some new tax code changes coming. Kind of what's your general take on the way the economy is going, how you're counseling your businesses, preparing for potential. I'm hoping we get some beneficial bonus depreciation, add backs in for real estate and certain things like that. Yeah. What are you seeing out there? What are you hearing from your business clients, and what are you sharing with them as we're in this fairly dynamic environment currently with some of the changes that are
absolutely
employed?
Yeah, it's dynamic is the word. I would say going back to last year and then through to now. Last year, a lot of people holding, a lot of people taking, if we give them a low, moderate, high scenario, kind of taking the safer scenario. Once was finished, we saw a surge of people moving more into the, hey, I'm bullish, at least the business owners. I'm bullish.
Yeah, I heard a lot of that.
I think over the last, we're talking today in late March, certainly probably the most dynamic trade environment we've had, at least lifetime, certainly my professional lifetime. And no one knows exactly what's going on, which creates, that's going to slow things down for certain types of businesses. I would say clients, e-com, especially that are importing, even some local businesses that are making some decisions. It's impact. So it's kind of shifted, I think, in those industries to where our CFO will be more conservative, say in a manufacturing space, but that can go both ways. If you're developing bolts, and I'm in Southern California, and we have in the Inland Empire here a lot of manufacturing businesses, family-owned manufacturing businesses that see big opportunity. We've got other industrial businesses that say, hey, if the tariffs increase, by 4% to say China, that's the break even for this major customer I have, and they actually want to shift business to us. So we're like in a good way, we're scared you're just going to double our business this year, but that also like we're taking some risk. And if those tariffs pull back or they go away, then that calculus changes again. They don't want to scale it right away for only a year, only 2 years or a short period of time. So making those CapEx decisions, I think, has become much more dynamic. In the professional services world, in the software world, even our nonprofits, like it's been kind of gangbusters. I'd say January was the busiest month we've seen all of our companies, even for us as a business, people coming in and saying, hey, we need help, navigating and navigating this growth. So I'd say it's a mixed bag. And I hope that we get to a point where we just have decided decide the rules of the game again, or reset the rules of the game from a tariff and cost perspective. And that allows everything to reset. Then the CFO can sit back and go, okay, now I can actually model it and not do these up and down scenario plans. So we like black and white, as a accountant, right? Like tell me what the rules are, and then we'll work around them. But the environment right now is, I would say, it's dynamic, and it's not as good, say, as it was in like November, December, January, when I think there was a lot of optimism. I think it's kind of pulled back, and we're in a little bit more see.
Yeah. No, and it's a great time if you're listening and you're saying, hey, I got some changes going on in my business. I need another set of eyes. Brennan's group, Vessel Advisors, would be a terrific resource for you there. Or if you're looking to buy a business, that thought popped into my head as well. And you might take a look and look through that. That'd be terrific. So Brennan, always enjoy our conversations. Thanks for coming on today. Again, Brennan de Raad with Vessel Advisors. Thanks so much for your time.
Yeah. Thanks, Chris. Thanks for having me.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.